Hi guys, my name is Rajiv Rebello. I'm the Principal and Chief Actuary of Colva Actuarial Services. We kind of like to refer to ourselves as the math advisors to financial advisors, and what we do is really help RIAs and financial advisors implement better after-tax, after-fee solutions for their clients. And today we're going to be talking about why charging a 1% AUM fee on low-yielding bonds without implementing advanced financial planning strategies will lose high net worth clients. And the reason, as we'll see later on in this presentation, is that on an after-tax, after-fee basis on these low-yielding bonds, these high net worth clients aren't really left with much, right? In fact, in many cases, as we'll see in the math, the advisor is making more on an after-tax, after advisory fee basis than the actual client is. So it doesn't make sense. So unless financial advisors are implementing strong financial planning strategies in exchange for the very, very high fee on the relative to the bond portfolio of their clients' assets, these high net worth clients will realize that it's not advantageous for them to use that RIA and essentially either move the bond portfolio portion of their assets elsewhere or take the entire portfolio and move it to an advisor who is implementing these kind of tax efficient, fee efficient solutions for them. So today in this presentation, we'll really be talking about this problem here and how to address it and how to help RIAs and their clients increase after-tax, after-advisory fee bond returns in order to retain and attract high-net-worth clients in an age of low bond yields and fee compression. So let me just talk briefly about myself and my firm. Obviously, as I mentioned, I'm an actuary. I started my career in the actuarial space, looking at life insurance and mortality and policy owner behavior. Eventually started my own firm, really aimed at, again, helping our RIAs increase better after-tax and after-fee solutions for their client, particularly on the bond portfolio of their allocations. And so that's one of the key elements of what we do today for RIAs in this space. So now let's kind of talk about the point of the presentation. Here's why paying an AUM fee on kind of low-yielding bonds, especially if they're taxable, doesn't really make a whole lot of financial sense for clients, right? So let's start with the top and we'll work our way down. So typically as kind of clients, and this is any client, whether they're high net worth or not, typically as they get closer to retirement, the allocation of their portfolio goes from being stock heavy to bond heavy near retirement in order to protect them against sequence of return risk. The issue with this kind of allocation change is that in today's environment, bond yields are at historic lows, right? On top of that, bond gains are highly taxable. So if you're a high net worth client staying in a high state income tax, that can be almost 50% of those bond gains being lost just to taxation. So not only are the yields low to begin with, you're also getting taxed at a higher rate. If the RIA is charging their AUM fee from a cash account on an after-tax basis, they're really not leaving the clients left with much. On top of all that, the client is taking the risk, right, which is interest rate risk on these low-yielding bonds. So either they're holding these bonds to maturity, and if they want to try to liquidate or exit, they'll absorb a loss if interest rates rise. Now, that being said, the yields are expected to be low for the next 5 to 10 years or so. But eventually, if you're allocating clients now a large portion to bonds, this issue will materialize over time. Another thing that kind of we'll be talking about here is that high net worth clients are kind of phased out of traditional tax advantage retirement plans where it makes more sense to hold their bonds, and how we can kind of create strategies or tax efficient strategies to account for this bond portion of the portfolio. So in summary, bond portfolios in a low yield environment, pose more risk than diversification benefits, and RIAs really need to implement better strategies to attract these high net worth clients. So again, let's kind of follow up on why, again, paying an AUM fee on a low yielding, especially taxable bond doesn't make a whole lot of sense. So let's just look at a quick example, right? The client is nearing retirement and the advisor chooses to allocate 40% of their portfolio to a short-term portfolio, kind of like the AGG, the Aggregate Bond Index, as the client nears retirement. So quick overview of the math, right? The gross return, we're going to assume it's 2%. In today's environment, it's actually less than 2%. We'll talk about that in a second. But for simplification reasons, we're using 2%. The tax rate is 50% for this high net worth client, and then the advisory fee is 1%. Again, this is on an after-tax basis. So let's just kind of quickly walk through the math here, right? So the client's after-tax return, they have the gross return of 2%, but then they're losing 50% of that to taxes. So what are they left on an after-tax basis? They're left with 1%. Now they have to pay the advisor his or her fee, right? So on an after-tax, after-advisory fee return, they're left with 0% because that after-tax return of 1%, they got to subtract the 1% AUM fee. So they're left with nothing here. Again, and this is assuming the bond yield, the bond portion of the portfolio is 2%. So again, the client gets nothing on a 2% gross bond return, and is still subject to interest rate risk losses in the future, right? If interest rates rise, right? So they're getting nothing, and they're taking all the risk, which is a bad kind of risk return reward scenario. I wanted to follow up this up with actually showing you what the current yields on the aggregate bond and muni bonds are today. Or not today, but as of June 23rd of this year. So the AGG was about 1.27%, so much lower than this 2% return. I also included muni bonds, which are tax-free, right? Because a lot of advisors in this environment really focus on allocating high net worth clients to muni bonds, but they're, even though it's on an after-tax basis, they're still not making much, right? So we subtract that 1.25%, that 1% fee from this. Okay, fine. Now the client's making 0.25% instead of 0, but it's still not much. They're still not really getting a whole lot of benefit, right, from investing this part of their bond portfolio accordingly, or using the advisor to do that, right? They very well could use this portfolio and just do the asset allocation themselves. I also, included the average maturity just to show you the interest rate risk potential here, right? So these, while they're shorter term bonds, these still come with interest rate risk. Obviously, the muni more than the AGG because of the shorter duration here. Again, eventually clients are going to realize this, right? Clients are going to realize that their net return that they're getting on the bond portion of the portfolio doesn't justify the fees, right? It doesn't make a whole lot of sense for them. And I'm going to walk you quickly through the math to see why this doesn't make sense. So let's say, again, you're a high net worth client, nearing retirement, your advisor decides to allocate you to a 60-40 portfolio, right? So 60% equities, 40% bonds. So let's assume the gross return on that equity portfolio is 8%, right? We're going to assume the marginal tax rate here is 37% because long-term capital gains about that for a high net worth client. The RIA's after-tax fee is 0.75%. So, skip the math here, but on an after-tax, after-advisory fee return, right, that's about 4.29%, right? So that's what the client's getting, right? The advisor gets this, right? So if we look at, well, what percent of the return is the advisor getting relative to the client, it's about 17%, right? So the advisor is getting this 0.75, but the client's getting this. However, when we look at the bond portfolio, let's take a look at that now, right? 40% is allocated here. So again, we assume the gross return. We talked about how in reality that it's right now it's less than this 2%, but that marginal tax rate for a high net worth client is 50%, right? So again, the advisor's fee is still the same, right? It's still the same on the bond portfolio as it is on the equity portfolio. So ultimately, right, the after-tax advisory fee return here is 0.25%. So it doesn't make a whole lot of sense because the client is getting 0.25%, but the advisor is getting 0.75%. So the client is taking all the risk here, right? If the credit spreads increase, interest rates move up, they're taking the risk, but the advisor is getting 3 times what the client is getting. So this does not make sense for a high net worth client, right? So high net worth clients will eventually realize one of two things, that it's better just to leave the equity portfolio with the advisor where this fee kind of makes sense relative to their net return. And they could, do low cost bond index funds themselves, just take that bond portfolio and allocate it into a low cost index funds for basis points. Or they're going to take both parts of the portfolio to an advisor who really implements better holistic, tax efficient, fee efficient solutions. So if you're an advisor that's not kind of implementing these solutions, eventually clients will realize that they're better off doing one of these solutions, right? Investing the bond portfolio themselves or taking the entire portfolio away and investing it with a firm that provides this comprehensive tax efficient, fee efficient solutions, right? As opposed to just a generic 60-40 allocation here. Again, the point of this presentation is that, or one of the points is that in a good economy, you can do simple asset allocation and that's enough. You just manage the relationship. You do 60% equity, 40% bond. Clients are less concerned about downside because the economy is doing well. The returns on their asset are doing well. So the fee portion is less concerning, right? But in a bad economy where it's volatile, where interest rate risk poses substantial risk, right, and duration risk here, clients are concerned about strong financial planning. And so now is the time where strong fiduciary financial planners can demonstrate their value add over other financial advisors and RIAs that are kind of just doing a simple asset allocation approach, right? So the strong financial planners with the tax efficient, fee efficient strategies will literally rise to the top. And I think in an age of fee compression, this is where the industry will go, is that clients will want to hold advisors accountable and demand better service, right, for what they're paying, right? Especially since on that bond portfolio, they're not getting a whole lot of benefit relative to their risk. So let's, talk about what are some of the solutions, right? What are some of the solutions that RIAs can implement to account for this kind of low yield bond portfolio solution, especially if they're in taxable accounts? We'll talk quickly about asset allocation, right, which is really putting the bonds and equities into the structure that minimizes taxes for them. That's really, taxable accounts for equities, tax advantaged accounts for bonds. We won't really go into in depth back to our Roth IRA conversions, which essentially allows, self-employed individuals to contribute large amounts to their IRA plan and then do a conversion to Roth IRA. So we won't really cover this, but if you're a financial advisor in this kind of environment, you really want to look at this financial planning strategy and see if it makes sense for your client. We will be talking about tax deferral and the benefits of deferring bond gain taxation until retirement, simply because high net worth individuals, again, whether they're, doctors or lawyers or other professionals who have a high income kind of coming in are typically in a high tax bracket while they're working, but in retirement, that tax bracket will drop. So there's an opportunity with tax deferral to defer taxes on their bond portfolio until they're in retirement, where they can kind of pull out the gains at a lower tax rate. We'll then talk about a key benefit for RIAs, which is their ability to charge their AUM fee pre-tax instead of after-tax. What this does is it reduces the taxable yield on the client's bond portfolio and ultimately creates greater after-tax returns. So we'll be going through a numerical example later that kind of shows this. We'll then be talking about no-commission annuities and the benefit that they provide, in that they allow clients and RIAs to invest in long-term bonds without interest rate risk, while also allowing the RIA to charge their AUM fee pre-tax. So a number of benefits here, right? Instead of settling for short-term taxable bonds, you can invest in long-term bonds that are tax deferred without interest rate risk, and you're also able to charge your AUM fee pre-tax, right? Which again reduces the client's tax liability and creates greater after-tax, after-advisory fee returns. We'll then talk about guaranteed lifetime income, right? And how in a low bond yield environment, clients can profit if they have a long lifespan and they really keep the policy. So it's a financial planning tool, which essentially all these other strategies are just some financial planning tools. We'll then talk about alternative investments, right? Typically, bonds are used to provide diversification against equity risk, right? But when the bond yields are low and subject to interest rate risk, bonds aren't really providing the diversification that they have in the past. So alternative investments, specifically uncorrelated assets, which are not dependent on on market risk or interest rate risk, can provide higher returns with better diversification than low yielding bonds with interest rate risk. And we'll go into one particular alternative asset class, which is life settlements, which I deal with, just to show you the benefits. We'll then talk about private placement or low commission life insurance, and basically essentially by ripping out the expenses and commissions in these products, how you can essentially use the tax code to take out principal gains tax-free, all while being able to charge your AUM fee pre-tax. So now let's jump into asset location and how you can match equity and bond portfolios with a tax optimal structure in order to minimize taxes for clients. So why asset location? So what you want to do is essentially with your clients' taxable accounts, manage a large portion of their equity portfolio in it, while you're using their retirement accounts to manage the bond portfolio of the client's portfolio. And the reason why you want to do this is because long-term equity gains in taxable accounts already get beneficial tax deferred treatment, right? And lower capital gains treatment. So about 23.8% top federal bracket. However, if you take those same long-term equity gains and put it in a retirement account, you no longer get this capital gains treatment. They're now taxed at ordinary income. So that's why you don't want to take equities, which are already tax deferred and get lower tax treatment in taxable accounts, and put them in the retirement account, because you're essentially losing this capital gains benefit here, and they're now subject to higher ordinary income tax rates. Again, with the federal brackets being a lot higher, or federal marginal tax rates rather being higher. Bond funds, on the other hand, distribute most of their gains as short-term ordinary income anyway, so you're getting a yearly coupon. the issue is that that's being taxed, right, at ordinary income. So if you're in a high bracket, that's getting taxed yearly. So if it's in a taxable account, you don't get that benefit of tax deferral. So by moving it into the retirement account, right, you get the benefit of deferring those taxes until they retire, as well as the fact that retirement accounts allow RIAs fees to be made pre-tax instead of after tax. And we'll be talking about why that's such a huge benefit, especially in a low yield environment. Okay, so now let's talk about why after-tax fees are a problem for low-yielding kind of taxable bonds. Just a quick math example. Here we're going to use the bond benchmark yield at 2%. Again, we talked about how the AGG, the short-term bond index, is lower than this, but again, it makes the math simpler by using 2%. High net worth client marginal tax rate, like the state in California, high state income tax, about 50%. RIA AUM fee is 1%. Again, typically it's a little bit lower for high net worth clients, but again, it makes the math easier by using 1%. So again, let's assume that you're just putting this client in a taxable bond portfolio, right? Short term, just to reduce interest rate risk, right? So the gross yield is 2%. You're not charging a pre-tax fee, so it's 0%. So the taxable yield to the client is 2%, right? Now they're losing 50% of this, to taxes. So that's about 1%, right? Their after-tax yield is now 1%, right? They've lost 50% of that. They're at 1%. Now they're paying the RIA fee of 1%. Again, they're left at 0. We went over this earlier, right? Well, what if they were able to charge this fee pre-tax, right? And they're charging their AUM fee pre-tax, thereby reducing the taxable yield. Let's look at that example, right? So the gross yield is still 2% in both cases. They're charging a pre-tax yield. So what that's doing is that's reducing the taxable yield. The taxable yield is no longer 2%. They're only paying taxes on this 1%. So the taxes paid are on 50% of the gain. So it's 50% of this 1%. So they only lose 0.5%. So again, there's no after-tax RIA fee. So because they paid that fee pre-tax. So what they've done is reduce the taxable yield, and the net client yield after taxes and the RIA fee is 0.5%. So they're getting 50 basis points simply by charging their fee pre-tax. So this is why it's so beneficial for high net worth clients to have their bonds in a taxable, or a retirement account where the RIA can charge their fee pre-tax. And retirement accounts have the added benefit of they allow RIAs to do this, right? And this is the key benefit, here for RIAs. Again, charging your advisory fee on a pre-tax basis increases clients' after-tax gains. So this is, again, a key focus of financial planning, particularly in a low bond yield environment. Again, why is tax deferral of bond gains valuable in retirement? Again, we talked about if you're a high, income individual, high net worth, you're in the working period, you're bringing a lot of income, especially if you're a W-2 employee, doctor, lawyer, etc. Even engineers to an extent. You could be at a high tax bracket if you're at the C level, especially. So when you're working, you're at a high tax bracket, marginal tax rate, ordinary income, right? Again, those bond gains are getting hit with a 50% tax rate. However, if you do proper planning, right, what's going to happen in retirement? You don't have that kind of W-2 income coming in. So what you can do is defer those gains, right? Defer those gains on bonds until you're in retirement in a lower tax bracket, right? Obviously, once you start taking retirement required minimum distribution, Social Security, your tax bracket will probably go up here, but there's a financial planning window which you can use for clients by properly structuring these kind of strategies accordingly. Again, by deferring bond gains during the high tax rate ordinary income period here to the low tax rate financial planning window here before their RMDs and Social Security, there's a financial planning opportunity for the financial advisor to show benefit and value add to their clients, right? Again, there's other strategies you can layer on top of this, right? So let's say the high net worth client has a second home in Florida with no state income tax, right? So they can move to Florida for 6+ months and then take out all the gains and then kind of come back. So there's ways of using financial planning strategies to reduce tax liability here. So now let's talk about, we talked about the benefit of asset location, right? Which is essentially just putting your bond investments in retirement plans. The problems with that, or the limitations rather, of that strategy is that those bond investments in retirement accounts are still subject to interest rate risk, as well as they're typically limited in contributions that high net worth clients or anyone can kind of put into them each year. So let's kind of compare the two of bonds in taxable portfolios versus bonds in retirement plans. So first, can you defer the taxes in bonds in taxable portfolios? No, you have to pay those taxes every year, whereas in bonds in retirement plan, you can't. Can you charge your AUM fee pre-tax? Not if they're in a taxable account, but you can if they're in a retirement plan or retirement account. Can I invest an unlimited amount, right? You can in a taxable portfolio, but you can't make unlimited contributions to a retirement plan each year, right? You can't do that. Can I invest in higher yielding long-term bonds without interest rate risk? You can't do that within a taxable portfolio, and you also can't do that in a retirement plan if you're just investing straight bonds, right? Because you invest in higher yielding long-term bonds, you're taking the interest rate risk. So that's the kind of downside. So the summary being is that if you're investing in bonds in retirement plans, you have contribution limits, and it still doesn't solve this interest rate risk problem that we're at. And obviously, like I said before, for the next 5 to 10 years, interest rates will be low. But if you're doing large allocations, right, this is your retirement plan strategy. When interest rates rise, if credit spreads rise as well, right, that poses problems for your clients. So now let's kind of cover, well, why can't my high net worth client just move my taxable bond portfolio to my retirement plan? You're moving all the bonds to a tax or to a retirement plan account. And again, we talked about asset location, why that makes the most sense. And the reason is that there are limitations, right? So if you look at your employee 401k plan, there are limitations here. And this is, highlighted here. Let me go back. This is highlighted here because this is assuming that they're 50 and up, right? If they're 50 and up, there's additional contributions they can make. Obviously, if you're self-employed, there's a larger contribution plans. You can contribute to IRAs. Again, we talked about setting up SEP IRA plans to defer taxes, and you can utilize this strategy to dump in a lot of the bond portfolio into a retirement account. But if you're high net worth, again, that's the limitation here. You can't do more than that in terms of moving money out from a taxable account into a retirement plan account where you get the benefit of tax deferral. So the summary being that high net worth clients are limited in their ability to contribute to tax deferred plans. So what are alternatives that we can kind of utilize to accomplish this, of moving our bond portfolio out of a taxable account into a retirement type account, which benefits from tax deferral, right, and the ability of the RIA to charge its fee pre-tax. So now let's talk about interest rate risk in low yielding bond portfolios and how, with yields at historic lows, rising interest rates pose significant upfront losses. I'll caveat that by saying that it looks like interest rates will stay low for the next 5 to 10 years or so. But as interest rates rise for a variety of reasons, significant risk is posed to the client's bond portfolio allocations. So why is interest rate risk a problem with low yielding bonds, right? Because low yielding bonds are subject to mean reversion. So what are situations in which the interest rates can rise, right? First, the Fed stops suppressing interest rates in order to stimulate the economy, right? So by lowering interest rates, the Fed is trying to encourage investment into the economy. So that when the Fed stops doing that, interest rates will rise. The economy could recover, and the Fed increases interest rates in order to fight inflation. So that's another scenario in which interest rates could rise. The third one is just the market loses faith in issuers' ability to pay back their bonds, right? So the fear that bonds defaulting will cause a rise in interest rates or corporate interest rates or the credit risk spreads. And we saw that recently, right, with the coronavirus. What happened is that the spreads on high yield debt really jumped through the roof. From about 5 on the high yield corporate debt, from about 5% to 8%, because all of a sudden, consumer or the market got scared of companies' ability to repay that debt. So here are 3 scenarios in which interest rates could rise and therefore cause significant losses to a client's bond portfolio. The other thing to keep in mind is just low yielding bonds have a higher duration, or in other words, higher sensitivity to interest rate risks or interest rate increases than a higher yielding bond, because a 1% rise in a bond that's given 10% risk is just a small rise, but a 1% rise in a bond that's earning only 2% is, again, a significant amount of the base interest rate, which of course means the potential losses on those bonds are higher. So let's just look at some quick math examples, which most of you already know already. What happens if interest rates are at 2% and rise by just 1%, right? So like we talked about, there'll be an immediate loss of market value on those bonds. And again, that loss is dependent on the term, like how long are those bonds, because longer bonds are more sensitive to interest rate risk and have a higher duration. So you can see if the bond is about a 10-year term, that's about an 8.5% immediate loss. If it's a 20-year term bond you're invested in, that's about 15%. And finally, a 30-year bond is about 20%. Again, longer term bonds offer higher yields, but also more interest rate risk. So that's typically why RIAs, when they're allocating client bond portfolios, especially as a client's near retirement, are allocating it to primarily short-term bonds. So they're giving up the higher yields of the long-term bonds in exchange for protection from interest rate risk. But as we'll talk about later on, there are better solutions. So now let's kind of think about it from a different perspective. Well, let's say interest rates rise, right? Yes, there's an immediate upfront loss, but then now the portfolio will be rebalanced and invested into higher yielding bonds, right? Well, how long will it take for me to be, or my client to be invested in those higher yielding bonds to recoup the initial loss? So let's just kind of quickly look at that, right? We talked about how it's a 10-year bond, it's about a 9% loss, right? So if you're investing, you're rebalancing that portfolio into higher yielding bonds, it'll take you about 4 years, right, to recoup the initial upfront loss. If you're invested in 20-year bonds, again, that period is longer. It's going to take you about 6 years. And again, 30-year bonds, it'll get about 8 years to get back, just to recoup this initial loss, right? Just to get back to ground zero, right? That's how long it's going to take. On top of that, clients are subject to sequence of return risk, right? Earning a higher yield, right, on a lower base is not an equal proposition here, right? So again, you've lost money here, and the increased yield that you're making is on a lower base amount. So important thing to keep in mind. So now let's look at how long will it take me to get back to my original 2%, right? When you allocated your client to that bond fund, the assumption was that they'd be making 2%, right? We talked about how long it would take to get them back to zero, just to get their principal back. Well, how long will it take them to get back to the original 2%, right, that you projected their portfolio would be at, right? So again, if it's a 10-year bond, it's going to take you 10 years for them to get back to this 2% point, right? If it's a 20-year bond, it's going to take 17 years of them investing. Again, they lost 15% up front, and they immediately rebalanced into a portfolio making 3%. Again, it took them 17 years just to get back to the original 2%. Again, if you're in 30-year bonds, it's going to be longer. It's going to take you 23 years just to get back to this original 2%. And that's the impact of interest rate risk loss on this. So when you're doing your projections, the other downside with financial planning software is they're kind of using current yields to project long-term interest rates. So you're doing a retirement projection over 30 or 40 years, but you're using current rates, right? So that's not in reality what happens. If there's mean reversion, that bond loss will take a hit, and you will rebalance. But again, if they're it'll take a while just to get back to that original assumption. And plus, they're withdrawing during this period, the sequence of return risk, right? So the downside with interest rate risk, of course, client loses both income, the RIA loses AUM fees. Again, with a lower base, with a lower upfront base, again, even if the future yield is higher yielding, right, that base, it's not an equivalent proposition. The client is losing income because that increased 3% yield is on a lower base. And the RIA is losing its AUM fees because the AUM fee is based on the market value of those bonds. So interest rate risk for just financial planning, financial advisory space, offers significant risk on that bond portion of the portfolio. Well, how can a no-commission annuity, solve the problem? And we'll talk about what a no-commission annuity is, in the later slide. But I just want to look at the couple key categories that we talked about earlier when we were comparing bonds and taxable portfolios versus bonds in a retirement plan. Versus bonds and a no-commission annuity, which an annuity is just an investment in long-term bonds without the interest rate risk, and no-commission annuities just rip out that expense. So let's kind of look at all three, right? So can you defer taxes? We talked about bonds in a taxable portfolio. No, you can't do that. Bonds in a retirement plan, of course, you can defer taxes until your retirement. Same thing with bonds and a no-commission annuity. The no-commission annuity, advantages are very similar to a retirement plan. Right, so can you charge your AUM-free pre-tax? Not if it's in a taxable portfolio, but you can if it's in both a retirement plan or if it's in a no-commission annuity, right? Can you invest an unlimited amount? You can do that in a taxable bond portfolio, but you can't in a retirement plan. However, the no-commission annuity allows you to put an unlimited amount into that essentially tax-deferred, interest rate risk protected vehicle, right? So think about the annuity is just a vehicle for the client to achieve these benefits. Can I invest in higher yielding long-term bonds without interest rate risk? You can't in a taxable portfolio. That's typically why RIAs allocate bonds in a taxable portfolio, short-term bonds, right? You can't do that in a retirement plan either, right? Those bonds still are subject to interest rate risk. However, with a no-commission annuity, you can protect against that, right? So the no-commission annuity solves contribution limits and interest rate problems of retirement plans. So that's the benefit that these no-commission annuities have over a retirement plan here. Is the unlimited amount and the ability to invest in higher yielding bonds without the interest rate risk. So now let's kind of go deeper into what no-commission annuities are. And we talked about earlier how essentially just an investment in long-term bonds without the interest rate risk. And what's happening here is this: The insurance company, has long liabilities, right? So, 20, 30 years out. So what they do is they invest in long-term bonds. And what they do, they go to the client and say, like, look, I'm going to offer you a yield that's going to be less than the long-term bond yield. So there's a spread here. But the benefit, if you're the client, is that there's not going to be interest rate risk. I will allow you to leave early. So you don't have to hold the bond to maturity, right? So that's the benefit to the client. So if the client wants to liquidate and get out, they can. And the insurance company is okay with that because they have long-term liabilities and they understand on a pool, right? On a pool, they will make money via the spread. They're going to make money via the spread that's going to compensate them for the interest rate risk, right? So that's the insurance company's plan. And obviously with a no commission annuity, the spread is little. If I put commissions into an annuity, then the spread has to be high, right? And it doesn't make as much sense. With a no commission annuity, the spread is lower, so the client is getting better value. So again, what is a no commission annuity? It's an investment in long-term bonds without interest rate risk that receives the same tax benefits of a retirement plan, except with unlimited contribution. So we talked about here the benefit here. So you get two benefits over a retirement plan: protection against interest rate risk and unlimited contribution. And again, the no expense load in the annuity allows for higher gross returns for the client, right? So again, when I rip out the commissions, the client gets higher benefits, a higher portion of that long-term bond, right? The spread is minimized. So these kind of no commission annuities are really built for RIAs, primarily fee-only RIAs, to earn their AUM fee pre-tax instead of after-tax. So as we talked about, this reduces tax liability for the client and then ultimately gives them a higher after-tax return for the client. On top of that, if you think about it, like we talked about earlier, if interest rates rise for a variety of reasons, right, the RIA's market value of that asset is protected. So that RIA, the market value of the asset doesn't drop, which means the RIA's fees won't drop, right, if interest rates rise. However, if they're investing in just regular bond portfolios, if interest rates rise, then the market value of those bonds drop and RIA's percent AUM fee drops as well. So the conclusion here being that RIAs can use no commission annuities as financial planning tools more effectively than retirement plans to get higher after-tax yields with more protection, particularly for those clients that are in high tax brackets where they can benefit from the tax deferral. So now let's kind of talk about what types of no commission annuities there are. The first is a fixed annuity. So again, you're just getting the long-term bond without the interest rate risk. So again, we talked about how the insurance company is just investing in long-term bonds and they're giving you a portion of that. Again, they're keeping a spread for their profits, but they're allowing you to exit without interest rate risk. So essentially, the client is exchanging part of the yield of long-term bond in exchange for interest rate risk and the ability to liquidate earlier than 20 or 30 years, right? So provides stable return for the client. An index annuity is similar to the fixed annuities, that is still the base underlying asset are long-term bonds without interest rate risk, but what the insurance company is doing with a small amount of that investment that you're giving to the insurance company is that they're buying options with a floor and a cap on an index. So, standard index, S&P 500 index. So if the S&P 500 drops below 0%, the client is protected, and if the S&P does really, really well, the client gets a portion of that upside gain. So for the client, it's protection against downside risk, right, of losing money versus a potential upside gain here. So you won't get the full upside gain, but you get a portion of it. So essentially here with an indexed annuity, the client is exchanging, again, part of the yield of the long-term bond for no interest rate risk. The benefits of the indexed annuity being that the returns will be higher, but again, they'll be a little bit more volatile than your fixed annuity yields. But still, they'll be generally less volatile than the underlying bonds. We'll show about that later, simply because the underlying bonds are subject to interest rate risk. So I think a quick way of trying to understand the value that no commission annuities here is just let's look at the historical results since they kind of came onto the market in about 2016. First, let's look at your typical bond indexes, right? Or indices, rather. So your AGG, your short-term bond, and your IGLB is a long-term bond indices. So 2016 to 2019, the AGG was about 3.5%. Then the volatility was about 3.28%. If we look at the long-term bond portion of the portfolio of the IGLB, the returns were much higher, right? But guess what? The volatility was also higher, right? So for an RIA, they're constantly choosing between yield and volatility, right? So they want to avoid volatility, interest rate risk, they stick them in short-term bonds. If they're truly trying to capture more of this yield, again, they go for the more long-term bond investments. Well, how do both the short-term and long-term bonds compare to no commission annuities, right? The fixed and index annuities. How did those perform equivalently? let's look at that here. So over the same period, the no commission fixed annuity was about 3.3%. So again, a little less than the short-term bond, but look at the volatility, significantly lower than the short-term bond, right? The indexed annuity, again, did better than the short-term bond, right? With about 150 basis points higher with similar volatility. So the volatility was a little bit higher. And that's where the play is. So if you want lower volatility in your portfolio, you can go with the fixed annuity. Generally will be about the short-term bond, a little less than that maybe. If you want higher returns with similar volatility to your short-term bond portfolio, the no commission indexed annuity is going to beat that with, again, similar volatility. And that's why, again, as a financial planning tool, this makes sense, right, than the current allocations. And we'll talk about that in a second. The summary being, no commission annuities offer either higher yields or lower volatility in the current bond allocations. And again, this is on the pre-tax side. We haven't even talked about the after-tax benefits, right? The ability for the RIA to charge its fee pre-tax. So this is just on the ability of the RIA to charge its fee on a pre-tax basis, right? So this is just looking at gross returns. So now let's look at kind of current no commission annuity results. Where are our annuity yields today, and what do they look like versus kind of just our current benchmarks? So again, the short-term bond index, if you look this up, it's about 1.27%, right? Right now, the long-term bond is a bit higher, it's about 3.21%, and here are the effective duration, right? How sensitive these are to interest rate risk. So we saw, obviously, it makes sense. A short-term bond, again, has a lower sensitivity to interest rate risk than a longer-term bond. But now let's look at the alternative options here with no commission annuities. The no commission annuity current yield is about 2.7%, right? Again, so that's higher. That's higher than the short-term bond. Again, it's not as high as a long-term bond, right? You're not getting that full spread here. Again, the company's reserving some of that, but you're protected from interest rate risk. You see how the duration is for the client. They're protected against it on the fixed annuity side. Obviously, the indexed annuity offers better returns and upside because there's participation, right? There's participation in the upside of the market with those options at a relatively low cost. I did want to mention that, again, this is simulated based on current projections. I just did a Monte Carlo simulation. And the rest of the yields were as of 6/26/2020, but it highlights the financial planning opportunity I'm trying to refer to in this current low yield environment. Is that, again, fixed annuities are either going to offer lower volatility than your long-term bonds. You're not going to get the full return of your long-term bonds, but you're going to get protection against interest rate risk. Whereas no commission index annuities will typically afford you better returns, but again, with similar volatility to your short-term bond allocations. So again, we talked about simulation. So what I did is I actually modeled this. I built a financial model and I modeled it. And I said, assuming the client were to, I looked at a case study of a high net worth individual in a high tax bracket. Essentially, if the advisor were to allocate the client to a taxable bond portfolio, right, and then charge their fee on an after-tax basis versus allocating that client portfolio to a no commission annuity, where it's, again, still long-term bonds, but ability to charge the fee pre-tax, how does that perform rather on a Monte Carlo basis? And then what I found in that case study was that in 83% of the scenarios, the no commission indexed annuity beat the long-term bond strategy. Obviously, if you were to compare this to a short-term bond strategy, if you're an RIA who completely avoids long-term bonds because of the interest rate risk, this number is going to be a lot higher. If you're interested in seeing the actual results, again, the white paper is called Investing in Long-Term Bonds Without Interest Rate Risk, the No Commission Annuity Solution to Improving After-Tax, After-Advisory Fee Bond Returns. You can look it up here at this link, www.covaservices.com, pdf/no-commission-annuity.pdf. You can also go to the Cova Services website under the white paper section, and you can find that white paper here. But this is the benefit. Again, we're all familiar with doing Monte Carlo simulations in our financial planning software, but when you really consider the benefits of both the yield component, the lower volatility, and most importantly, the ability to charge the RIA's fee pre-tax, right, instead of after-tax on a taxable account, it makes a lot of sense, especially in a low yield scenario. The other thing I wanted to address was the huge opportunity that RIAs are missing by not including comprehensive financial planning tools like no commission fixed and index annuities in the services that they offer their clients. So fixed and index annuity sales have been going through the roof, and it's projected to jump even higher as, again, clients are worried about both interest rate risk and kind of volatility in the market. So generally, as you know, as a financial advisor, clients are more emotional than rational, and they want some sort of protection. Fixed and index annuities offer them that protection of principal. So they're more afraid of losing short term than they are of kind of gaining over the long term, right? Or preferring the benefit of long-term gains, right? So that short-term fear, results in them. They want fixed and index annuities. And again, in 2019, over $200 billion of client money was invested in these products, but RIAs are not offering them. So it's a double-edged sword, because RIAs, the fiduciaries, the fee-only guys, the ones who are really mathematically inclined, who would act in the best interest of the clients, are not offering it. So what are clients doing? They're going to high commissioned agents. So this $200 billion was not no commission annuities. No commission annuities make a small fraction of this. These are actually high commission products, right? So are not necessarily in the best interest of the clients. But again, the fee only RIAs are not offering it. So what is the client supposed to do? They want the protection. They want the protection that these products can provide. So instead of going to a fiduciary financial advisor, they're going to a high commission insurance agent who's selling them an annuity, which is what they want, but it's not a good one, right? So the point I'm trying to make here is there's an opportunity with no commission annuities and with fee compression and with the industry going increasingly fee only, for RIAs to use this as a financial planning tool. Again, not the high commission product, the no commission one, which provides better value for both the client and the RIA on an after-tax basis. So this is a way for fiduciary RIAs to provide added value to a financial planning strategy. Again, RIAs can establish this and kind of capture this part of the market, which they're essentially losing to high commission competitors. So next, let's talk about guaranteed lifetime income. And what guaranteed lifetime income is, it's a client paying an insurance company a deposit in exchange for guaranteed lifetime income for as long as that client is alive. And that income is backed by the company or the insurance company's long-term bonds in exchange for mortality risk, right? So typically, these guaranteed lifetime income yields are higher than the long-term bond yields because the company is taking mortality risks, right? So if you live longer than your expected life expectancy, the company will have overpaid you relative to that long-term bond yield. On the other side, if you died before your life expectancy, the company would have made a spread, right, on what you actually earned on that investment versus what they did relative to investing in long-term bonds. So the insurance company is able to make this mortality play because they offer it to a wide spectrum of clients, right? So they're making a bet here. So they're offering you higher yields than long-term bonds in exchange for them taking the mortality risks, that you live too long, or in your case, that you you live too long and you run out of retirement income. So again, how can clients benefit from guaranteed lifetime income in a low yield environment, right? Well, guaranteed lifetime income, the amount that the company is willing to offer you is based on three key criteria: the bond yields, the current long-term bond yields, right? The mortality of the population, which is stays fairly consistent, right? And lapsation or canceling the policy, how many people cancel the policy and when they do. So guaranteed lifetime income yields, like we talked about, are higher than long-term bond yields because life insurance company expects some clients to die early and some clients to cancel their policy early. So who's getting the benefit, right? The insurance company knows that some people will live longer than expected, and those people will benefit, right, at the expense of people who die sooner, right? So those people who die early are getting a loss for doing guaranteed for investing in this product relative to the long-term bonds. However, the clients who live a long time, they come out ahead. Correspondingly, clients who cancel their policy early, right, lose money relative to those who keep the policy for a long time. And that's where the key criteria are dependent on determining how much this guaranteed lifetime income the insurance company makes, right? So in a low yield environment, like the mortality of the population and the policy owner plays a much bigger component in pricing than the low yielding bonds. What that means is that there's an opportunity a bigger opportunity relative in a low yield environment for clients or policy owners to benefit from mortality and the lapsation effects of other consumers. So what that means is if you're a policy owner who is in great health and utilizes this guaranteed lifetime income as a financial planning tool, you will end up benefiting at the expense of other policy owners who die early or cancel the policy. And why this is of added benefit for high net worth clients is that high net worth clients live longer than people of lower incomes, because people of lower incomes don't have access to health care, right, that the high net worth clients have. So if you actually look at mortality studies by wealth, you'll see that higher income people live longer than lower income. So there's an opportunity here, right? So if you have a high net worth client and they're worried about spending too much in retirement, there is an opportunity. If they're in great health and they use this tool, they essentially keep the policy. And because the yields are low, there's a bigger opportunity for the policy owner to profit off this than if bond yields were higher, and then they could just invest in the higher yielding long-term bonds. The point being is that for your clients in this low yield environment, particularly in high taxable brackets, there's an opportunity to protect against longevity risks, protect against the client outliving their retirement income, specifically if they're in great health, right? And they keep the policy. So next, let's talk about alternative assets. We talked about how typically RIAs and financial advisors use bond yields to offset equity risk, right? So it's a diversification strategy. However, when interest rates are low, right, the bond yields don't provide as much diversification as they have in the past. So alternative assets, on the other hand, can provide better diversification for a number of reasons. One, they can provide higher yields. Two, if they're uncorrelated assets, so if those assets are not correlated to the market risk or interest rate risk, you can provide better diversification with alternative assets, uncorrelated alternative assets in particular, in a low yield environment. So let's just kind of talk about alternative investments as an asset allocation and the benefits and disadvantages just real quick, right? So obviously alternative assets are non-traditional investments. We mean non-stocks, non-bonds, things like hedge funds, private equity, real estate, life settlements, which is an area that I specialize in. So these are non-traditional investments, right? So what are the benefits of the alternatives? We talked about higher returns. You can get higher returns, particularly if you're funding that from the bond portion of your portfolio. Again, we talked about better portfolio diversification if the underlying asset is uncorrelated to the market, right? So now let's talk about, well, what are the disadvantages, right? Typically, you need to be an accredited investor to invest in these alternatives. So there's high investment minimums. We're talking, 100K, 250K or higher, depending on the asset class. Again, it can be illiquid, right? A lot of these alternative investments are illiquid, so you have to invest for a longer period of time. They can be taxed at higher ordinary income rates. Now, not all alternative assets are taxed at higher ordinary income rates, but some are. Point being, you really need to do due diligence on that. But this can play an effect, especially if you're in a high tax bracket. They can be riskier than traditional investments. Correspondingly, they can be less risky than traditional investments if managed properly. The high level being that alternative assets can provide a higher risk-adjusted return relative to both the stock and bond portions of your portfolio, but it's extremely important that due diligence is done on both the asset class and the investment manager, because that's where the risk-adjusted return comes from, the combination of these two, right? That's why the spread is there. Like, not all asset managers will be providing the same return. They don't have the same expertise. So if you're thinking about investing in alternatives or investing in alternatives for your clients, it's really important that extra due diligence is done on both, right? But there is an opportunity here, more so than in high-yielding bond environments, for alternative assets to provide better portfolio diversification than kind of low-yielding bonds. I'm now going to talk about the alternative asset class that I specialize in, which is in life settlements. Typically, these can provide 7% to 15% net uncorrelated returns, again, with liquidity, depending on the structure. And again, the returns, again, depend on the structure and the asset manager and the quality of the asset managers investing in the space. But the high level idea being that you can utilize specialized actuarial and insurance expertise to provide investors access to an institutional asset class, right? And again, as an actuary, it's easy it's easier to manage mortality risk, right? Especially if you have large numbers, than it is to manage market risk or interest rate risk. So it's very difficult to understand how the economy will do, whether the S&P will go up or down in the next few months or years. It's really difficult. to kind of project that on any kind of data, whereas I can project mortality rates based on data, and it's easier to manage mortality risk and mortality-dependent cash flows than it is market-dependent cash flows. And the benefit of it being uncorrelated kind of adds that portfolio diversification. So let's talk about, well, what is a life settlement? A life settlement is a financial transaction in which the owner of a life insurance policy sells his beneficiary interest in that policy to a third party for a value greater than he could receive from merely canceling it. So in other words, a policy owner has bought a life insurance policy for whatever reason. They realize, I don't really need it. I can't afford to pay it anymore. I want to give it up. However, the problem with life insurance is that it comes with a high surrender charges. So it's almost like a gotcha, right? Like you buy into the policy, you realize you don't need it, you try to exit it, but they hit you with a huge surrender charge. So you walk away with almost nothing. So again, that's a key, downside of life insurance policies with surrender charges, and again, commissionable products, force the surrender charges. That some policy owners get into it and they cancel and they walk away with almost nothing, right? Which is a benefit, right, to both the insurance company and people who keep their policy, right? Because they benefit from the insurance company, the clients who cancel early. So again, the high-level transaction, the policy owner seller, again, sells their policy to the life settlement buyer, and this is, again, all regulated, right? So the life settlement buyer makes a cash payment to the policy owner. The life settlement buyer then again takes the responsibility for paying the premiums on the policy going forward, but the life insurance company will pay the death benefit to the life settlement buyer. So let's talk about, well, why would a policy owner sell their policy? Again, 65% of all permanent policies or UL policies never pay a death benefit, and they're canceled early. So this is part of the pricing system, like we talked about earlier, is that a lot of policy owners will just cancel their policy, and the insurance company is like, yes, right? By the policy owner buying the policy, they paid in premiums to it and really never got a death benefit, right? They didn't get it, and the insurance company is using that in their pricing system as actuaries to determine what price to pay. The corresponding side is that policy owners who keep their policy can kind of benefit from it from people who cancel early. The other reason why policy owners will look to sell their policy is that they can receive a higher payment from a life settlement than from canceling the policy, right? We talked about how the high surrender charges means they'll get almost nothing back if they cancel it, versus if they sell the policy, they'll get a much higher value. And again, they can't afford to or don't want to pay the expensive premiums. If they bought it when they were young, when their kids were young, now they're older, their kids have grown up, they don't need the life insurance policy. Maybe they need to take a vacation, or they need money to pay for healthcare expenses, right? So this is a way for providing them liquidity. On the life settlement buyer side, why would an investor want to buy it again? Is because there's a kind of mortality arbitrage opportunity. The insured is now in worse health than when the policy was purchased, and the insurance company can't come back and say, okay, oh, you're in worse health now, I'm going to raise the premiums, right? They can't do that. So there's a mortality play here. On top of that, you have access to actuaries like myself who can really realize, okay, here's what the opportunity is, and we can minimize premiums relative to what the average policy owner thinks they have to pay, right? So in reality, you can pay a lot less on the policy than what the typical client ends up paying, but there's complicated math formulas involved in doing that. The other thing is that by selecting the right policies and diversifying your pool, you're able to take this mortality risk, whereas the policy owner, again, they don't know when they're going to die exactly, but paying the premiums on that policy might not make sense because they don't know how long they're going to live. They might end up paying more in premiums than the death benefit, right? So the insurance or the investor, on the other hand, is willing to take that mortality risk because they're diversifying that mortality risk amongst a wide array of policies. So let's talk about who has invested in the space, right? So again, large institutional players have invested, billions of dollars collectively. Talking AIG, Berkshire, Fortress, Apollo. So these are large institutional players who have allocated large sums to the space. And the reason why is because of this opportunity to invest in uncorrelated assets, given you have the right specialized expertise, right? So there is a risk margin, and we'll talk about that. The discount rates relative to the life settlement investments are significantly higher than both high yield corporate debt and high quality corporate bonds, right? Again, we can see here high quality corporate bonds are less than 5%. High yield corporate debt, again, was around 5%. Again, we talk about how it peaked here because of the coronavirus. Life settlement discount rates are significantly higher. So there's an opportunity with the right expertise. Again, there's a risk adjusted spread, but some managers are better than others. So there's an opportunity to profit from this the spread and discount rates with the right expertise. You can provide higher risk-adjusted returns, right, than just investing in either high-quality corporate debt or high-yield corporate debt, right? So in a volatile equity, low-yield environment, life settlements offer a significantly higher return profile that has uncorrelated economic conditions. Again, with the right asset managers, right? Not all asset managers are equivalent. The life settlement asset class is essentially an institutional investment that's made available with specialized expertise to retail investors. And again, by collecting on this spread, you're not only providing higher returns to client. Again, you're providing better overall diversification because these cash flows are uncorrelated. So for those interested in learning more about this topic and more about life settlements and potentially utilizing it as an alternative asset strategy for your clients, I did write a white paper on this as well called Investing in Life Settlements, Utilizing Specialized Expertise to Provide Investors Access to Uncorrelated Returns. So the direct link is here, just https://services.com/pdf/lifesettlements.pdf. So you can type in the link. You can also go to our colvaservices.com website and just go to the white papers section of the site and download it from there. So now let's move on to talking about private placement life insurance, right? Which is essentially just taking tax inefficient alternative assets and placing a tax-free wrapper around it, which is the life insurance product, so that clients can benefit from the tax code, similar to how you put, like we talked about, bonds in retirement accounts so that they can benefit from the tax benefits of the life insurance or the tax code with regards to retirement accounts. So by placing these tax inefficient assets within this tax-free wrapper, which is private placement life insurance, it allows clients the ability to withdraw both principal and gains tax-free. So obviously for high net worth clients in a high tax bracket, that can provide a lot of benefit, right? So again, let's go over what private placement life insurance is and why it allows clients the ability to take out principal and gains tax-free. So life insurance, just the tax code around life insurance, allows clients to invest in the underlying assets and take out principal and gains tax-free. However, the downside with most typical life insurance policies is that the commissions and expenses in these products kind of negate the tax code benefits. So yes, you can take out the money tax-free, but you're paying, more expenses to do so. So it doesn't really make a whole lot of sense. However, private placement life insurance kind of rips out a lot of these commissions and expenses while also allowing RIAs the ability to charge their fee on a pre-tax basis. So for high net worth clients getting in high tax brackets who want to use alternative assets as a diversification strategy, this is a great way to do it and to make it tax-free. Again, let's kind of look at the example of investing in alternative assets, tax inefficient alternative assets, without any kind of wrapper, without any kind of benefit of the tax code, and see how it provides kind of a lower after advisory fee return. Again, in this example, we're looking at the gross return is 8%. The high net worth client's marginal tax rate is at 50%. So that's what they're getting taxed on these kind of tax inefficient assets. Again, the RIA's AUM fee is 0.75%. That's taken after tax, right? After they pay taxes on it. So again, quick math. This is just by year of investment, right? So we can see that it's 8% in every year. Simple assumption. The after-tax return, again, they're losing 50% of that, right, to taxes. So it's about 4%. Again, that's 0.75% is taken after taxes. So net, the client is looking at 3.25% on that 8% yield. So now let's move on to talking about how we can use private placement and the benefits of the tax insurance, code with regards to life insurance to benefit. So here's just a graph. Again, we're going to start with the yellow line, which is just assuming the client invests in alternative assets directly. So these are, again, tax inefficient. They're getting taxed at 50%. They're getting their 3.25%. However, if they invest in private placement universal life or variable universal life, which kind of rips out the expenses, we can see that, yes, in the beginning years, right, the return is not so great. But what happens is that after you reach a certain point, let's say year 10, you can pull out all 90% of the money tax-free via a loan and the withdrawal and basis, and you're getting about a 5.7%, 8% return, after tax-free, right? That's a tax-free return versus your 3.25%. Again, that's if you take it out in year 11, right? You're waiting that long. If you wait a little longer, like if you keep your money in longer and then take it out, in year 20, the returns are a little bit higher. It's above 6, so about 6.1%, right? So this type of strategy, this tax-free wrapper, allows a client, again, who has a longer horizon, right, to invest in these alternative assets, and then boom, they take out 90% of the money and benefit from the tax insurance code, and they're good to go, right? So if the client can wait 10 years, again, typically, high net worth clients have a longer investment horizon. They're getting, more than 250 basis points, after tax, after advisory fee spread, by doing so. And plus, again, like we talked about, the RIA is charging their fee, the AUM fee pre-tax versus, on an after-tax basis here. Again, if you're interested in learning more about this, I did write a white paper on this as well. It's called Increasing After-Tax, After Advisory Fee Retirement Income for High Net Worth Clients, the Private Placement Life Insurance Solution many fee-only RIAs and family offices are missing. So here's the link. Again, you can just type in the link or just go to the colberservices.com site, go to our resources, white papers, and you can download it there. So again, let's summarize in the last few topics on how to use life insurance and annuities as financial planning tools, particularly in this low bond yield environment, and how we can use them to provide specialized expertise, which provides clients better after-tax solutions, right? And again, better for the RIA as well, because they're able to provide more tax-efficient strategies, again, and draw and attract those high net worth clients to the services and value add that RIA is providing versus other RIAs who are not. So what are the highlights of working with COLVA? First is that we can provide life insurance and annuity solutions at no additional cost to RIA or their clients. So the cost of acquiring the product is the same, whether your RIA partners with COLVA or works with the carrier directly, right? So there's no difference. There's no difference in price here. The difference in service is that you get COLVA working with you as your partner, providing optimal actuarial structures, solutions, and customized feedback that the carrier won't. Again, fee-only advisors don't need to be insurance licensed. Often, the worry here is that the RIA needs to have insurance licensed advisors on staff. They don't with some of these no-commission life insurance products or the private placement products. They don't have to worry about being licensed because they're just charging their fee on the assets under management here. Again, you get low expense, better performing, and no surrender charge products. We partner with insurance partners in the field who have access to greater than 90% of carriers in the marketplace, and then we kind of utilize our expertise to look through all these products and provide the structure, right, that is actuarially optimized for your clients to benefit. And that's something that's not currently being done, right? All the actuaries are on the side of the insurance company working to make the product profitable for the insurance company, not on the side of the policy owner making it profitable for the policy owner. And that's exactly what we do, is especially as these kind of companies go towards no commission, no load products, right? It really makes a lot of sense, especially if you can structure it properly. A key critique of these kind of no commission annuity products, is that it's not as operationally efficient as kind of the ability of advisors to simply rebalance, right? Right now, if you want to rebalance your client's portfolio, you just click a button and you can rebalance between your client's bond portfolios and their stock portfolios. It's not at this point as operationally efficient. In the next 5 years, I would expect it to be, right, as the industry progresses. Not there today. So in order to compensate for this, our insurance partners can help rebalance multiple clients' accounts at once. So this kind of takes out the operational difficulties of implementing these products away from the RIA and onto kind of our insurance partners in order to make it more operationally efficient. So we went through the numbers. We showed it how it is more tax efficient on an after advisory fee basis, but it is at the moment not as operationally efficient. And that's where our insurance partners really kind of come in and take that burden away from you. So it allows RIAs to provide a better solution to their clients. Again, if you're interested in working with us on any of these strategies we talked about here today, you can contact us through a variety of means. First, just our website. We talked about the white papers. You can access the white papers there. Our emails, send us an email, support@colberservices.com. You can give us a call, 1-800-561-4028. Again, we'll hopefully be posting a lot of kind of financial planning tips on our blog. You can also follow me on LinkedIn, as I'll be posting these topics as well. Again, how to improve after-tax, after advisory fee solutions. I did want to conclude with the references if you were interested in kind of learning more about some of these topics I shared here today. Here are a bunch of references that we used in kind of compiling the information that you saw here in this presentation. Anyways, I hope you learned a lot from this presentation, and you can benefit from these strategies in implementing higher after-tax, after-advisory fee solutions for your clients, again, particularly on that bond portion of the portfolio. Hopefully you'll reach out and contact us with regards to how we at Colva can kind of help implement those solutions for you. But either way, hopefully this is giving you information that allows you to make better and more informed decisions for your clients. So thanks for listening, and hope to hear from you soon.